Hello guys, welcome back. Let's now discuss a small concept. We move towards investment appraisal advanced questions, and that concept is related to capital allowance. There are two types of depreciations. One is that a company charges in its income statement, and that is purely based on the company's own estimates, which we call accounting depreciation. The other is the depreciation that is charged or allowed by tax authorities. That depreciation is purely calculated on the formula given by the tax authorities. What they do is, when they calculate tax liability, they reduce our taxable profit by capital allowance figure. Say for example, let's say we have sales of say $20,000. We have cash costs of say $12,000. So excluding the tax depreciation, our net cash flows will be $8,000, right? So what the tax authority will be doing is they will subtract capital allowance from this figure, and then they will charge tax. The impact will be a reduced tax, and that reduction is one of the reasons why this tax has been reduced is the capital allowance. So there is a benefit because of this accounting, the tax depreciation that the company is going to receive. Since capital allowance is a non-cash expense, therefore usually we do not subtract this figure from our cash flows while calculating net present value. So we don't subtract it, and when we don't subtract, our net cash flows will be $8,000 in this case, because we are not going to subtract any depreciation. So if we don't subtract this and we just simply charge tax, which we usually do in our NPV calculation, if we charge tax, let's say 30% on this amount, it will be equal to $2,400. But this is not the tax that the tax authorities will be charging. The tax authorities will be charging us tax after deducting a certain amount related to capital allowance from 8,000, and then they will be charging tax. Let us suppose what that amount is going to be. Let's say we have asset that has a value of say $1,000. We have bought it for $1,000, and let's say the tax authorities allow tax depreciation of say 25% on reducing balance basis. So they will take 25% of the cost of the asset, 250, and subtract this amount from our net cash flows, and then they will charge tax. So let me write these figures again to just explain how the tax authorities will do. So after this, they will also subtract this 250 amount from the 8,000 amount, and then they will charge tax on this 7750, which will be 30% say of 7750, and that tax amount is surely going to be less than the one we calculated a while ago. This is without subtracting the capital allowance, and this is after subtracting the capital allowance. So the actual tax that we are going to be charged will be $2,325 and not $2,400. So you can see that there is a reduction in the tax. Let's check it out. What's the reduction? The reduction is of $75. So our tax liability has been reduced by $75, and that is very obviously because of this capital allowance figure. Now if we do this calculation, there is nothing wrong with this calculation, because we haven't included any non-cash item, which is a very right thing to do in case of NPV. But the problem is, because of not deducting the capital allowance, the tax figure is overstated here. So if we are following this approach of calculating net present value, where we do not subtract capital allowance, then our tax is surely going to be overstated, and in this case it's overstated by $75. So to adjust this, we have to add back the $75 figure into this figure, because this shows a higher tax deduction, whereas the actual tax deduction is less. So we have to add back $75 to adjust this impact. But how are we going to calculate this 75? There is a very simple way. As we know that this tax reduction is just because of this 250 amount. Had there been no this amount, there wouldn't have been this deduction. So it's basically this amount which has resulted in tax deduction. So the tax authorities have basically given us a tax benefit on this amount, which is equal to the tax rate, which is 30%, and multiplied by this 250. It will be the same 75 that we have written here. So we can simply pick this figure from here rather than calculating it in this way. So what we can do is we will just calculate capital allowance of each year and multiply that capital allowance figure with the tax rate to get the tax benefit, and add this tax benefit back into the cash flows to adjust the tax figure. So let's say we move forward and let's do it for the next years as well. So the WDV after the end of the first year will be 750, right? So I'm just assuming that this asset has a 4-year life. So I'll just depreciate it for 4 years. Let's say what happens. So this capital allowance figure for the next year is going to be 25% of the WDV for the first year. So $188 will be the capital allowance figure for the second year, but we are not supposed to take this figure as our cash flow. We will be multiplying with the tax rate to get the tax benefit of this figure, and tax rate is 30% in this case, and let's multiply it with this. So $56 is going to be our next year's capital allowance. So calculate WDV again, that this WDV will be at the end of the second year. And that's going to be 750 minus 188, 563. For the third year, the capital allowance figure will be 25% again of this figure, 141, and again we have to take 30% of this figure to get the tax benefit amount, which is 42. And then we will have WDV at the end of the third year, which will be 563 minus 141. That's it. If fourth year is its last year, then there is no need to calculate capital allowance. All we have to do is to subtract scrap value from this amount in the last year, if it's there, right? Let me explain why we are doing it. You know, we bought an asset which has a value of $1,000. Instead of giving us the whole amount as expense for the first year, the tax authorities are giving us proportionately $250 in the first year. Out of 1,000, they have allowed us to charge expense of $250 in the first year, then $188 in the second year, and then $141 in the third year, and the remaining amount of the asset is $422. This is something that the tax authorities haven't allowed us to charge up till now. They haven't allowed us. So 422 is the amount that they should allow in the last year if there is no life left after 4 years. But sometimes you know that after the end of the useful life, the asset may have a scrap value, that it may be sold for some price. So from 422, if there is any scrap value, let's say it's $100, I'm just assuming. So if I assume that after the end of the fourth year, this asset is going to be sold for $100, then forget about that the tax authorities will be allowing the 422 amount as your expense, because you have already recovered $100 by selling this asset. So the only amount left will be $100 that they are going to allow you to charge as expense, and this is called balancing allowance rather than capital allowance. This will happen in the last year of the asset. So this is the fourth year in this case, 422, and the tax authorities will allow this as an expense, and the tax benefit will be 30% of this amount, and that's $97. So each year we will be adding these figures into our cash flows. So in this case, this will be added in the first year, this will be in the second year, then third year, and then fourth year. So these are the tax benefits. We call them tax benefits on capital allowance. And these are just calculated to adjust the tax figure. Now I'll just show you a shortcut of calculating the same figures. Just look at these shortcuts. Just think for a while that these are our years, right? Year 1, 2, 3, 4, and this should be shown in year 1, and then 2, then 3, then 4. So I'll just show you a shortcut of doing it. First of all, just pick the 1000 cost of asset, apply the depreciation rate, which is going to be 25%. So if you do it, it will give you the 250 figure, and then multiply it with 30% to get the tax benefit, this 75, right? That's for the first year. In the second year, what you need to do is, you just look at this, what's happening here. Every year, 25% is deducted from the asset value and 75% is left. And the next year depreciation is available on the 75% value of the asset. So each year, the value of the asset is reducing by 25% and the leftover value will be 75%. In the same way, it will reduce the tax benefit at the same rate. So if we just reduce 25% from the previous year tax benefit, it will give us the tax benefit of the second year. So just minus 25% from this, or just take directly 75%. So if I just take 75% of this value, it means I'm reducing it by 25%. It will be equal to what we have calculated here. Every year we have to take 75% of the previous amount, so that 25% is deducted. Here we go, we've got this third year one. So we don't need to go through all this stuff. This is a shortcut that you need to apply in case of a reducing balance sheet. But in the fourth year, there needs to be some adjustments. So the cost of asset was 1000, right? And we have to reach to this 422 figure first. And you know that this figure was calculated by reducing it by 25% every year. That is taking 75% every year. So we just have to take 75% of this figure once, then 75% twice, and then 75% thrice to get to this 422 figure. Let's see, yes, it's 422. Now we have reached here, right? But instead of multiplying it 3 times, it's better that we take power equal to 3. Because we depreciated this figure for 3 years, as the life of the asset was 4 years. In the fourth year, we are not supposed to depreciate. We have to subtract the scrap value and then charge the rest of the amount completely to income statement. So this is going to give us, the bracket figure is going to give us this 422. And imagine what we did last time. We just subtracted the scrap value from 422. So let's subtract the scrap value from this $100. When we subtract this $100 from here, we get 322. That's called the balancing allowance. Now we have reached to the balancing allowance figure. So let's put bracket around these figures. So that the answer is going to be 322, right? But 322 is not the tax benefit. The tax benefit is 97. So we have to take the 30% of this figure to get the tax benefit, and that's 97. So in this way, we will be able to calculate our tax benefits, and these will be shown that these should be added back to the cash flows of each year to get to the net present value figure. So I'm just keeping these files in the Google Classroom so that you can access this file and you can see these formulas as well. Thank you.